change approaches the unreal. For those who think and feel in touch with some reality beyond the gilded day. Cast in this LA road, illiquid to act within submission dark. One must put up barriers, oneself in time.
All right, and this particular program, which of course the federales are going to stop me from getting paid for, is dedicated to Rush and to Geddy Lee. If you're in the Boston area, Geddy Lee will be appearing at a bookstore in Braintree tonight actually. Let's pull it up here. And I'm bummed that I can't go to this thing. So if any of you can go see Geddy Lee at this book signing tonight, I would recommend checking it out. So let's see, what do we have? Okay, so Geddy Lee will be in Boston at Brookline Booksmith tonight. I believe it's at 6:30. So go check that out if you're a Rush fan. If you're not a Rush fan, check out Rush. Awesome, awesome band. Okay, let's get on to some earnings play stuff here. And I'm going to try to be very clear with my positions because it gets kind of confusing when I start talking about options and I'm going back and forth and people get confused sometimes. So let's go to Beyond Meat. Okay, so my Beyond Meat position right now is I rehashed this whole thing with the strangles. So right now my Beyond Meat position is I am short the November 110 put and the November 235 call. Thus I'm short the 110 235 strangle in November in Beyond Meat, which I just put my Beyond Meat position back on today, and I sold that strangle for $17. So we will watch this carefully. Beyond Meat, of course, has earnings on the 29th of July coming up in just a little while. So we'll have to make a decision before earnings about whether we want to leave that position on or not. Now, I've showed people this before, but let's do it again. To find possible earnings plays, a lot of times what I do is I go to barchart.com, and let's pull it up together here. And this is a free website. I always like free stuff. And if we go under the options tab here, we can either look at highest implied volatility or percent change in volatility. Let's look at highest implied volatility first. So this is going to give you option prices that are off the board. And so if we pull up this, we can see, well, let's see, we've got and if we look on the left side here, I'm looking at prices, right? And if there's a stock that the price is like $2 or something, then I disregard it immediately. I want something that's got some meat on the bones, let's say over $20. So as I'm going down through here, I see AXTA. Okay, let's pull up AXTA. So if we go back to our Thinkorswim, we can type in AXTA. So, and we can see that this one, it's some anomaly because we can, if we look at above my head there, you can see the volatilities are in the 30s. So there's it's some like expiration day anomaly here. And this kind of stuff happens a lot with these. So let's move on to the next one. So I'm going to go back to bar chart and I'm going to pull up options, highest implied volatility. And it looks like, yeah, it looks like this call, it looks like it was kind of a bad quote there. It says bid 95 cents, ask 480. So it's just a really wide market that got, they sampled the market when it was really wide, and it gives sort of an inaccurate reading. So let's keep going down the page here, and we've got SKX Skechers. And actually, if you look down the page, there's a bunch of SKXs here. So that makes me believe that maybe it's more legit. And we'll come back to that in a second. Let's just keep looking here. BHVN. Let's check out BHVN. BHVN. And you can do this yourself, you know, just go through and check out some stuff. BHVN, once again, it doesn't look like there's huge, looks like there's wide markets, but and it looks like some big trades happened here in these strikes. Maybe something was recommended or something. It looks like some big spread went up. Look at this, 40-55 strike. So anyways, this can lead you down rabbit holes, and let's go down one right here. Let's investigate what this big trade that happened in BHVN was. It's not necessarily related to our earnings stuff, but just while we're here, out of curiosity, might as well see what this big spread that went up was, right? So we've got, it looks like somebody sold the July. Looks like someone sold a boatload of July 40 puts and bought July. It looks like maybe they bought the July 55-40 put spread, which is, And then, what else is going on here? And here's this other spread, the October 55-35 put spread. So they were buying the 35 put, selling the 55 put. That's strange stuff. Let me think about that for a second. All right, so let's go back to SKX, which was another one of them on that list. Okay, Skechers. And I was looking at this a little bit earlier. That's why it appears in the description of the video. And Skechers has earnings coming out today. Okay, and when we pull up the charts, we can see that the front week is jacked so high that it's actually, the prices are almost equal to the options 2 weeks out. So we see, if we look up here at the implied volatilities, we've got 228% on the first week, 109% second week, 83% third week. Now, let's look at and see what that means in real number terms. Well, if we look at the at-the-money call, okay, so stock is 34.54. So the at-the-money strike, you could say, would be the 35 strike. So if we look at the 35 strike 2 weeks out, we've got a market of 220 bid at 235. If we look at that same strike expiring tomorrow, we've got 2 bid at 220. So very similar markets. So this creates an opportunity. What we can do is we can buy this calendar for very inexpensive. And we could first, let's look at the chart for a second. Okay, so when we buy a calendar coming into earnings like this, what we're looking to do is we're looking to pick the strike exactly where this is going to land after earnings, which we don't know where it's going to land, right? So, but we want to, that's the trick. And this, when we're buying a calendar like this, it's almost like we're selling a straddle in a way. It's kind of like a safer way of selling a straddle. So, and so what we're looking for is this just not to move too much, or we're picking a spot where we want it to move to. So if we're going to be doing the at-the-money calendar, the 35, then we're looking for this not to move too much. And if we look at the last couple earnings, well, this February earnings, it looks like it gapped from 27 to 32. 5-point gap up. And then this next earnings looks like it gapped down. And then today, we have this earnings. So it could gap up or down, but it looks like each time it has moved a bit. And let me just plug this at-the-money calendar into our analysis tab, just to prove to you that this is kind of similar to selling a straddle. So, okay, let's do that. So let's buy the August 35 call. So I'm going to click on the offer for that. And let's sell the July 35 call. So I'm going to click I'm going to hold control and click on the bid for that. So it's showing a price of 18 cents is the midpoint here. So let's say we put this on, we did this trade 10 times. So doing this trade 10 times would cost us about 200 bucks, right? 180 bucks plus, well, for me, 20 commissions. And if we pull this into our analysis tab, what I'm doing is I'm going over and I'm right clicking on the trade ticket, and then I'm selecting analysis to get to the analysis tab. And I can kind of pull this up and make sure this is the only trade in the analysis tab right now, and it is. Let me just move over to the side here. And we're looking at our Greeks here, and it's showing us, okay, long a little delta. We're slightly long here, but look at this decay that it's showing. That's just because this event's going to happen, it's going to move, and this is all going to be over within 1 day. So this is like a 1 day trade. It's like you put the trade on, earnings comes out, it makes a move, and then you take it off. And you can see if we go to graphically illustrating our position, it shows us here. And let me try to pull this down so you can see it a little bit better. So there's more space here. All right, so if we make most money, if it stays at 35, and then if it moves away from there, we start losing money. See that? So it looks exactly like being short a straddle. And our break-even points here are 46 and 27. Okay, so you pay 200 bucks, you make money if it stays between 46 and 27. Seems like a good little thing to do. Okay, and now what if we, instead of doing this, let's click off of that. What if we had just straight up sold the straddle, the July 35 straddle? What if we sold that one time? So sell this call and then go over here and sell this put. Okay, so if we sold the straddle for 465, let's pull that into our analysis tab. Okay, it looks similar, right? Except here's the difference. A, it's going to cost you more money. You're going to have to put up at least $1,000 instead of 200, and B, you're going to start losing money quicker. So essentially, I guess if you put on maybe 25 of these calendars, it would be similar to selling one straddle maybe. So what if we jack this number of calendars up to 25? All right, that would actually be the break-even point. So the break-even point would be 27. As we jack this up, the break-even point comes in, yeah. I'm sorry, the break-even point stays the same, but you make more money. So, so they're similar though, in that if you stay at the strike, you make money. As it moves farther away from the strike, you lose money. But the straddle is much more risky, and you know, if you look here, things go downhill for you and get worse and worse the farther this moves away. Whereas the calendar, in the end, you can only lose what you pay for it. Okay, whereas a straddle, you could lose an infinite amount if it moves up, straight up. You couldn't lose an infinite amount to the downside in a straddle because eventually it's going to get to zero and you're stopped out. But to the upside, you could lose an infinite amount. Whereas this calendar spread, you could only lose the 200 bucks that you paid for it. So it's interesting. Now we could look at another strike too. Instead of looking at the money, we could pick something like we could say, all right, well, you know, I think that they're probably going to have good news here. Let's check out the 40 strike. And the thing with this is if it tanks down, then you're probably going to lose whatever money you put in on this trade if you pick the 40 strike, because those calls are going to be worthless. Basically, what you're betting on when you do a counter like this is what are the the calls that you buy or the puts that you buy, what are those going to be worth after earning? So if you're looking at the 40 call here, okay, if it gaps up, these are going to be worth something. And you're going to be financing them by selling the front day ones that only last a day. Same thing with the puts. If you think this thing's definitely going lower, then you might buy the August 2 puts, 30 puts, and sell the front week puts against them. And so you're financing either buying a put or a call with the high premium that is built into this trade because of earnings. And so you want to pick the strike where you think the stock's going to go to. And most of us don't know where a stock's going to go to and maybe don't even want to venture a guess. So in that case, if we have an inkling that maybe this isn't going to move all that much, then we can trade the at the money calendar. And in this case, I don't know. It's hard to say. I guess I don't know. I guess I would say the at the money calendar. So let's just do this trade. Let's actually do this trade just like twice or something. Okay, so let's see if we can get filled here. So I'm going to buy the August 35 call, and I'm going to sell the July 19 35 call. And if I do it one time, it's going to cost me $22. So let's, instead of doing it one time, let's do it maybe 5 times. Okay. And let's see if we can get filled here. And they don't want to fill us at the midpoint here. So we may have to pay up slightly. What if we try to pay 25 cents? We'll go down to 4, paying 25 cents for this. And we're filled. We bought 5 of these calendars, paying 25. All right, so we'll check back tomorrow and see what happens with this earnings. If we don't gap too far one way or the other, there should be a winner. Now let's take a look at our chart here. And it's showing us with this trade, we're a winner between 28 and 44 and a half, it says. So between 28 and 44 and a half, we are a winner, according to this trade, this chart. All right, so there you go. There's an earnings play. Now, I like these better when the options are meatier. Like, let's say that this was a much higher price stock, and we were buying one option for for $23 and selling another one for $22.50, and we were paying 50 cents. I like fatter ones like that because there's more potential in them. All right, well, let's take a look at CHWY for a second here. CHWY. Similar situation, earnings between today and tomorrow. And we've got the front week, same thing, 227 vol. But the difference is that we don't have weeklies in this one. So the next closest option is the August option that expires in a month. Okay, so there's a little bit more meat on this bone. But essentially the play that you're executing is you are financing either buying a call or a put with the high premium associated with earnings, and you are making a wager that this isn't going to move too much. So with this one, I was looking at the August 30 July 30 put vertical. So if you were to buy the August put and sell the July put, okay, so you would pay 75 cents for this, and let's just say that nothing happened on earnings and everything just stayed right here. Then you would be basically paying in the end 75 cents for this August 30 put here, and 2 days from now, volatility after earnings should come in. So maybe this goes down from 79 to 69, and these puts go down to like 155 bid at 175, something like that. But still, 155, paying 75 cents in the end for it is cheaper than 155, and this would be a winner. let's model buying this put spread. So I've got the trade right here, and then I'm going to right click on this, and I'm going to click Analyze Trade and bring it into our Analysis tab. Okay, so let's say we put this trade on 10 times. So if we put this trade on 10 times, our break-even points would be 26 and 35.5. And this would cost us about $775 to put this on. And it's showing decay of $337 a day, but we know that that's just for today and tomorrow. And this trade, like the other one, is basically, well, you don't necessarily have to take it off tomorrow, but if this put that you sell, the July put, is in the money, then you're going to have to do something tomorrow. Otherwise, you're going to end up having to sell someone's stock. So you're going to, if this ends up below 30 tomorrow, then you're either going to have to take the trade off, or you're going to have to buy in your July put. You have to do something, because this put would be in exercise tomorrow, and you would get assigned on it if this ends up below $30 tomorrow. So these kind of trades, you're going to have to, you put them on today, and tomorrow there's a good likelihood that you're going to have to take some action, whether it be just taking the trade off. Usually what I do is I just take the trade off. I bought this calendar and I sell the calendar back out tomorrow. But, if in the case with this one, if stock, went to 32 and this put your short is out of the money, you might just ride it out, and you'd end up being long one August put, thus being short. You're going to be leaning short this stock. You're short some deltas. And you've gotten this put maybe for an advantageous price, but you are short some deltas. So you're going to have to figure out, all right, do I need to buy some other option or sell some other option to adjust my deltas? Do I want to buy stock against this put, or do I just want to sell it straight out? Usually on these kind of trades, like I said, you put the trade on, and then once earnings comes out and it makes its move, you'll just take the trade off, and that's it. You pocket the money if you made money. The beauty of these trades is that they're relatively low risk, because in the end, all you can lose is what you put up. So if you buy this one time, then you're putting up $75 plus commissions, and the most you can lose is $75. So it's a fun trade that can make you a little scratch, and you can trade these in small size. I don't think you can trade these in really super big size, because I don't think anybody who's out there is going to be willing to sell you a whole lot of these spreads in between the markets, just because there's not a whole lot of benefit on the other side. The only reason a market maker might want to do this is just because they're trying to get some inventory of that front week options, and this helps them. They can trade around the spread because they've got a lot of stuff going on, A, and B, it helps them maintain some sort of inventory of these front week options, which they need to sell out to somebody else right away. So that's why people take the other side of this kind of trade, but I would not recommend taking the other side of this kind of trade. All right, so there you have it. I hope that gives you some little more clarity into an earnings calendar spread. And let's see what we've got going on right here. And thanks for watching, and we will see you in the next video. Let me know if you try any of these out, and check out Geddy Lee from Rush if you can today. He's at a Brookline bookstore. You can go to the Rush website for more details. He's signing copies of his book on, I believe it's different bases that he's owned, and history of different bases. Really cool stuff. I'm a huge Rush fan, and in that vein, we can end with a little bit more of Rush, as I've already ruined my ability to make money on this video. So here we go with that.